Hi, everybody. Sorry we were running a few minutes late. We had some technical difficulties that we were working through, but we appreciate you joining us today for a state of the market being presented by Sentinel Net Lease with our Chief Investment Officer, Dennis Cisterna, and our Chief Executive Officer, Fred Lewis, who we will be bringing into the meeting shortly. This is just a preview of what we want to share for what we see coming into 2026 and how we are approaching the commercial real estate market and managing through those opportunities and challenges. And with that, I am going to turn it over to Dennis Cisterna, our Chief Investment Officer. Dennis, take it away.
Thanks so much, Laura. I appreciate it. Just want to confirm that my screen is actually visible and people can see the presentation.
Yes, it is on.
Okay, great. Well, thank you all for joining today. Fred and I are excited to take the next 30, 45 minutes to discuss what we see going on in the market. And just at a very high level before we begin, this is not a presentation on our specific strategy. This is what we're seeing across the market, across sectors, across strategies, some macro elements, and also some insights for you as potential investors that invest, in a variety of asset classes, some things to be aware of as you consider new investments going forward. So with that, just a little bit about Sentinel Net Lease. For those of you that are not investors or are not familiar with our firm, we're a privately held real estate investment company. It was founded by myself and our CEO, Fred Lewis. We've known each other for about 15 years. We started Sentinel in late 2019. And our primary focus is acquiring single tenant office, industrial, and retail assets in suburban markets across the U.S. So to date, we've acquired about $350 million worth of properties across 16 states. We really try to focus on high yielding assets that are mission critical, really a needle in a haystack type of strategy that has provided pretty profitable for us thus far. We did our first 20-something deals as individual syndications with hundreds of different investors. Last year, we launched our first fund, and we continue to buy assets in that fund as well as raise capital within that fund, which is Sentinel Opportunity Fund 1. Just a quick background about Fred and myself. We are both lifelong professional real estate folks. Fred's background started a large vertically integrated residential real estate platform called the Dominion Group. They own hundreds of townhomes throughout the greater Maryland area. They're one of the largest private lenders in the residential fix and flip and single family rental space. Fred also serves on the board of directors at Capital Bank of Maryland. So we'll get some unique insights from him on what's going on in the banking industry right now and how that might impact you as a participant in the commercial real estate market. My background, frankly, I've done just about everything you can do in this market. Started my career as a housing market analyst and economist, worked my way up in the home building and development sector, only to transition into private equity and in commercial real estate lending. So I think you'll find that both of us are very experienced in the commercial real estate sector. We have exposure across a wide variety of asset classes, both on the debt and equity side of things. So hopefully you enjoy this presentation. So we're going to really break this down into three core categories. One is market drivers. Two is strategy and sector opportunities. And the third one is what we call intelligent investing. And that's really to give you a breakdown of some of the things that we see that we like and don't like in the market across a variety of opportunities. So we're going to start with understanding how equity is being deployed in the commercial real estate market. So you probably are aware that we are really at a high point in terms of capital being available to invest in the market. But as you can see here, really since interest rates were reset in early 2022, that has really downshifted the market dramatically in 2023 to present. And that is because the market is disconnected. The bid-ask spread is wide across a variety of markets. There's not enough spread in terms of cap rates relative to the cost of debt. And so that mismatch is really keeping the market a little stalled. You can see where levels even were projected at right now, other than COVID, which kind of impacted everything for most of that year. We haven't seen levels this low since 2014. And as you might imagine, there has been a substantial amount of price appreciation over the last 11 years. So it's a little misleading to say we're kind of back towards historical norms, because we certainly are not. And so what we are seeing is a lot of institutional capital either putting money to work on ultra core assets or larger macro strategies, or kind of sitting on their hands. And so for a lot of value add and development strategies, a lot of that has been picked up by smaller operators, family offices, syndicators. But as you might imagine, those groups do not move the needle as substantially as institutional investors do, which is why we see this lower level of investment volume. And we think we're going to see a continued lower volume for 2026 and beyond. Now, I think that still means there's opportunities out there. You obviously have sellers that have to capitulate to market demands at any given time for a variety of reasons. And I think that's where the opportunities are. And so for investors that have patient capital, the opportunities are there. If you have $1 billion and a gun to your head to buy now, you're probably going to buy some assets you wish you didn't. Interestingly, when you look at what's going on in the commercial real estate market, it's a little bit of a hot mess, because there's nothing really occurring on a uniform basis. And so that has made the market more opaque, a little bit turbulent. And so in some situations, office is a great example here. You see office values have declined nearly 40%. The cap rates for offices has expanded by more than 50%. Now, is all office bad? No, but the general sentiment towards office is negative, and so the baby's getting thrown out with the bathwater there, where you're seeing outsized price corrections at a macro level for that sector, despite being strong fundamentals in certain markets for certain properties. And so that's where you have some price discovery and advantages, where you're not competing against large institutional investors. And if you can be nimble and thoughtful with what you invest in, there's some serious arbitrage opportunities. Conversely, if you look at apartments and single family rentals and industrial to a degree, and a couple other asset classes as well, you see that cap rate expansion has occurred, but not nearly to the level some of the other asset types. And so part of that is you have this massive glut of institutional capital that is long macro bet on housing and industrial. And so that market is not getting the proper correction to the current rate environment. Now, again, institutional buyers are a little slower on this than they were in the past, but they're still active in that space because of the macro thesis. They find they can raise capital around those strategies easier, because you talk about kind of a ever-growing demand with not enough supply. But obviously that's something you need to be very careful about, because if everybody thinks there's not enough supply and we build too much of something, then we have an oversupply, and ultimately demand goes down. You're seeing a little bit of that in the apartment market this year, in a variety of markets that had a ton of deliveries in 2024 and 2025. And now you're seeing a lack of NOI growth and some concessions in those markets, making what are not attractive yields to begin with even worse. And obviously these are macro sentiments, so you need to gauge individual opportunities in each of the markets. But it is pretty interesting to see the wide disparity in valuations and cap rates across property types. We're going to talk a little bit about the debt market right now. Obviously, in commercial real estate, leverage is king. Whether you need debt for construction, bridge loan for a value add property, or perm for a stabilized asset, Debt is everywhere and pervasive in our market. And the biggest corrector of the commercial real estate market was the increase in the federal funds rate by the Federal Reserve and the ensuing changes in the 5 and 10-year Treasury, which are the primary driver of permanent loans. So what we're seeing right now is that the new baseline is this elevated level where you're seeing the federal funds rate, substantially higher than it's been during that zero interest rate policy during COVID. And so as a result, I think you've started to see some stabilization now at this higher baseline. If you look between 2023 and really the end of 2024, you'll see while the federal funds rate was generally pretty flat, the treasuries were bouncing all over the place. And that was a function of the treasury market trying to outguess what the Fed would do, a variety of whether they were risk on, risk off. And that volatility, while the federal funds rate was stable, was a pretty unique condition. And so now we're starting to see where those rates are actually moving in lockstep. And right now, we think, the cuts that occurred were nice. They didn't have a huge meaningful delta on borrowing costs, but helpful. Ultimately, though, it's a balancing act. Sellers see interest rates go down 25 basis points, and they think that ultimately, great, now I can get 25 more bips of cap rate compression to sell my asset. Where in reality, those interest rate reductions are really just starting to free up the market a little for potential increased volume. But it's only if you have sellers willing to hold to their pricing line and not try to get greedy. Otherwise, you're going to be in that same stalemate we've been experienced on a larger level across the country for the last few years. The other thing to consider is if we do have a dramatic drop in interest rates, it's because something bad has generally happened. A contraction in hiring, a collapse in consumer spending, a large credit event, or even a broader recession. And so, the path back to those rates that everyone loves and desires and is frankly part of way too many people's business plan, it's only going to come through a lot of economic stress that's going to cause more harm than good. Laura, has Fred joined the call?
Yeah, I'm here.
Okay, great.
I think what's interesting to this point is that a lot of assumptions were made pre-COVID into COVID as to rent growth assumptions, value growth, home price appreciation, so on, that not only hasn't held, but likely will not hold at all. And so the market's trying to understand how to reassumption real estate in different classes, whether that's multifamily, single family, whether it's office, industrial. So that's really what's going on right now. And there's different risks associated with each of those. And what's also kind of interesting is that the risk departments, the chief lenders, or the people who ran the credit side of banks and large institutions sat in the back seat during low interest rate environments. They were told to sit back down. Everything's fine. Everything is just going to keep going up north. And so the kind of credit philosophy was kind of muted over the last number of years. And what's really kind of materially changing now is that the credit departments are taking front and center, and the guys in the on the front who are trying to push sales or a transaction or lend money are now more risk adverse because they're looking at their NPLs or looking at what Dennis is going to show you as a kind of a lot of loans.
Fred beautifully jumped ahead of my next two slides here, but I love it.
Okay. And I think it's really it's very, very turbulent today than it was before. Now everyone has talked about when are markets going to disrupt, or when are markets going to decline? When are we going to see a recession? That's been a conversation over the last 5 years. Of course, that hasn't happened, but I think the factors around turbulence and the factors around pressure towards some recessionary pressure is there today more than ever. And I think 2026's outlook is materially affected for a lot of folks, on that side.
Fred, to
So,
that point, let's take a deeper dive into kind of what we're seeing in the commercial real estate lending market, because this obviously is a big driver of liquidity and overall investment volume. I think these are two new slides that we've created just for this presentation. And I think for those of you that have heard about the commercial real estate maturity wall, this explains it in a nutshell. And so the slide on the left shows the billions of dollars of commercial real estate loans that were paid off versus those that were not paid off on an annual basis. And I started this in 2020 because that was really the first year where there was a notable amount of CRE maturities that were not paid on time. And a lot of that was attributed to COVID. But what was interesting is as we went on, those those non-payoffs continued to accelerate. And I'm sure you're all familiar with the term kicking the can down the road. It's surprising that this exacerbated in 2021 because the market was fairly normalized then. We were still in a zero interest rate policy and money was flowing. But going from 2022 onward is really where you see that acceleration, where the amount of commercial real estate loans that were not paid, it reached that inflection point in 2022 and beyond, where now, as you know, 700, 800 billion dollars of loans are maturing. The majority of them are not being paid off on time, which means they get pushed to another year, which is the chart on the right, which shows you what it looks like today and for the ensuing 4 years, what those maturities look like in this wall that has been created. And so in 2025, for example, you have, you know, $600+ million that were originally $600 billion that were originally supposed to mature this year. And on top of that, you've got another 330 billion plus that had been extended from previous years. And now, even using a conservative 50% payoff for the years going forward, you can see that there is this roughly 400 to 500 billion wall of real estate loans that keep getting punted to the next year. And so, Fred, I think it'd be really good for it's a little bit of a scary proposition that there's, you know, $1 trillion plus of maturing loans for the next several years. But I think it's also important for people to understand what type of pressures are these lenders facing right now, or frankly, what lack of pressures are they facing that allows them to punt on these deals when it comes to a lack of regulations, maybe their own internal financials.
sure. Well, I think first, everyone understands that the lender's the debt, and the folks that are experiencing real disruption or changes in their economics or the equity. And the debt, the lenders, they're incented to try to get the equity guys to work it out. They don't want to take the assets back. They don't want to mark to market the asset on their books. Every time a loan for a lender is classified as non-performing, it goes on some non-accrual status and therefore they have to reserve more money against it. Lenders don't like to do that. They prefer to work out terms to extend their loans to give the folks enough chance to figure it out. And what we're seeing is lenders who underwrote loans at whatever the loan to value equation was, they're at a much higher elevated number. And so last year, I would have told you, you know, when I sat, you know, I sit on a bank board, they would say, hey, our kind of watch list has a much higher percentage of loan to value than we've had in a long time. And today they would say, and we've had these conversations, our NPLs have doubled. And that is a narrative that most community banks are talking about right now, is that their non-performing loans are substantially higher. It doesn't mean they're experiencing losses on a large scale. It's just that now the writing is on the wall. They're kicking these loans out, as Dennis illustrated. They understand that the percentage of equity left in these loans are smaller and smaller. And they understand that as soon as they default them or take the assets, they got to write them down. They got to mark them to market. And if they have a lot of them at one time, and there are banks who have a lot of them, this is the next slide essentially, those banks can go on tilt. And so there's a lot of pressure not to have a substantial amount of loan flow back to the banks. So they're doing everything they can to hold the line, but that line is getting it's getting thinner and thinner right now. And I was mentioning to Dennis earlier that for 2026, there's a lot of banks who really feel that there's a pressure on values down, and there's a pressure in the general economy at the same time. So that turbulence and the doubling of NPLs over the last 12 months is a substantial kind of critical sign.
And Fred, taking a look at this, this is a list of the top 25 banks as they are ranked related to their CRE exposure as a percentage of the bank's equity. And so you see some phenomenally high red flag numbers here across these banks. Now, some of these banks are not very big. Others of them manage tens of billions of dollars, if not more. What we're seeing in this market as an active lender is there are groups that have CRE exposure that is drastically lower than this, much lower than even 50% of their equity towards CRE. And those groups are open for business for new lending opportunities. They love this new elevated rate environment. Whereas you have a lot of banks like this that are really overexposed, have not necessarily taken a write down here. And Fred, is part of that motivation because these banks have seen what happens when you release too much bad news too quickly, like Signature Bank or First Republic, and because they don't have regulatory pressure, they can slowly leak out these problems?
Yeah, there's a tremendous incentive to solve problems in small chunks at a time, because otherwise you have to over reserve, and all banks are regulated by some body, some various body, and I think they're trying to manage that. And if they take too many assets back, for one, their buckets to lend on commercial real estate may actually stop. They may go under some type of MOU, which is an order from a regulator to stop lending until they correct the problem, which is happening more and more today. And as a result, once you see some of the larger banks go off, they just stop lending in a various bucket. Then other banks that are in a similar situation get very defensive, and they stop lending. So there's a cascade aspect to that, and the whole banking system is really trying to manage this more slowly. They're aware. It's interesting, Dennis. I would say a year or two ago, this was all lip service. Banks were they understood that credit risk and oversupply was becoming a problem, but they didn't see it in loans that were hemorrhaging. They just saw NPLs grow, but then they would be worked out. And now they're seeing it not be worked out. And so I think we're heading to a very different period where banks are going to start taking things in a methodical way, looking for buyers, looking for investors who are liquid. Liquidity is going to reign the day. Flexibility is going to reign the day. And those that are good operators who have lots of experience, can execute with liquidity, are going to have opportunities in 2026 they probably didn't have in 2024. So, a lot of this is exasperated by your earlier point of oversupply. I think that a lot of folks leaned in and kept building multifamily, and they kept building in certain cities and certain parts of the country where they wake up and they're like, we can't achieve lease rates. We can't achieve rent rates. Rent rates across the country are relatively modestly equal or lower, but rent rates in certain parts of the country, like West Coast of Florida and certain parts of Texas, Austin, and other cities, are experiencing substantial rent declines and oversupply.
Well, the problem is you had a lot of those kind of starting mid change in the interest rate environment, right? And unfortunately, there's no such thing as being a little bit pregnant. So they had to see that that project to fruition and hope that the market would be on the right side of their terms, and in many cases it wasn't. Let's dive in a little bit into sector and strategy. This is a lot of information on a page, and I realize looking at it now on my full screen, it may be a lot to digest. So what's great here is we will send a copy of this to everybody, so you can digest it at your own time instead of going through this. But what this slide does basically, and what I want to convey to you is, even though as Sentinel we're only focused on really core net lease as a strategy, we have experience and we survey these other market opportunities constantly. As a group that has 400 plus LP investors in it, we get sent deals to spot check for our investors from time to time, and while we don't offer that as a service, sometimes we'll at least look through the offering documents and be like, wow, this is delusional. And so what we want to convey here is, right now in the market, you have a lot of groups that are still essentially underwriting using a playbook from 2020 or 2021 versus today. And so you're seeing deals marketed with IRRs that are not really tethered to reality, regardless of their strategy, whether it's core, value add, opportunistic, even development deals. And so there's a lot of unrealistic assumptions across the board there. And so when you kind of look at the general gross IRR by strategy across sectors, you can see that some of these have extremely low likelihoods of actually reaching that target at all. And the realistic gross IRR is usually a couple hundred basis points lower, if not more. And that's because, as we'll go into, there's a lot of variables at play here in all your investment strategies. And the further you go up on the risk scale, the more variables that you don't control. And so I'll let you guys look through this at your own pace, but you can really see that the vast majority of these strategies, as they're marketed with their current IRRs, really do not have a high likelihood of being achieved. So take that into consideration when you're looking at deals, and we're going to give you some tools to utilize going forward when you're analyzing new opportunities for yourself, whether you're a GP or an LP. So digging into kind of what really makes a good deal a good deal, NOI growth is a great equalizer in commercial real estate. And so I wanted to give you a couple examples to really take a hold of and understand the impact that NOI can have on overall return. And so here we did a multifamily, a retail, an office property, very simple analysis. We assumed all of them cost $1 million. We didn't use leverage. This is just very basic for you to understand the power of compounding NOI growth. And so with the multifamily deal, it's a 5 cap. Retail, we bought it at 7. Office, we bought it at 9. And then we compared different NOI growth rates over the next 5 years of 50 bips, 200 bips, 350 bips. Historically speaking, you'll be hard pressed to find any sector that compounds over 3.5% per year. And so when we look at that, we look at the NOI that's created from the yield and the NOI growth, and then we look at the value creation from that NOI growth, because obviously at a higher NOI basis, if you sold it at the same cap rate you acquired at, you would create some additional value. And so you can see on the multifamily side of things, you're buying something at a 5 cap, and you only get 50 basis points of NOI growth. Your yield sucks to begin with. You're probably acquiring this with negative leverage, so it's even worse if you're actually financing it. And 2, you're not creating a lot of value for that property from that actual NOI growth to the disposition cap rate of the same at 5%. So you're only generating, a 5.5% return on a per annum basis on a stabilized multifamily deal. Whereas you can see if that gets to 3.5%, which is what a lot of these rosy projections are, if not higher, well, all of a sudden that is over an 8% annual return between the yield and the value creation from NOI growth. But that value creation from NOI growth, it's generally speculative on a stabilized asset. You can't control what's going to happen in that situation unless you have contractual rent increases, which is what you would see in a net single tenant net lease deal, where you have bumps of X% per year. All your expenses are already covered by the tenant. Therefore, you can predict with great confidence what your NOI growth will be. But in a lot of deals like multifamily, you may not necessarily have those that NOI being achieved, and therefore you have to become more reliant on the actual yield of the property, which is not particularly attractive right now. Conversely, you can look at something like office where you're like, wow, it's a 9 cap, that's amazing, but it could experience, very low NOI growth because it doesn't have the sector tailwinds that multifamily or industrial has. And so you'll find in those scenarios, though, if you're buying it at a good enough yield and you're able to cover your operating expenses and other capital expenditures correctly, you can end up at a higher total return because you bought at the right basis and yield, even if the NOI growth is slower. And so to the right of this, and that's just an exercise you can use to play around with. Anytime you're looking at a deal, look at what a sponsor's assumptions are when it comes to NOI growth. Is it contractual? Is it speculative? Is it based on something they're doing to the property? And what does the IRR look like if you start to toy around with those assumptions? You'll be pretty surprised by how an 18% IRR becomes a 12 pretty quickly. And then to the right, this just gives you a little color on what we're seeing in 2026 and beyond in each of the sectors. And so you'll see there's not a huge amount of disparity between the NOI growth of all the asset classes. Nothing is above 3.5%. The lowest is net lease at 0.2, and that's usually because it's got some flat rent element to it. If it does, hopefully the net lease buyer is a little more intelligent than that. But regardless, it shows you that the whole universe of real estate kind of works within some realm of a tight bucket. On the other end of that is NOI drag, right? What is going to actually make my NOI worse, or what is going to change the economic cap rate of my deal? And so we want to show you two things here. One is below the line, right? So when you buy something at a cap rate, you're looking at the NOI. What a lot of investors are frankly terrible at doing is assessing what percentage of CapEx, capital expenditures, they're going to spend on that asset over the short and long term, because those dollars are not part of the NOI or the cap rate calculation, but they are dilutive to your overall return. And so the higher that CapEx percentage, the lower the economic cap rate of the deal. And so some property types just naturally have more capital expenditures than others. Office and senior housing, office and hospitality, lead the charge. You have property improvement plans for hospitality properties. For office, you have large tenant improvement allowances that are needed. Now you'll see that those asset types also start at a higher cap rate, so their economic cap rate is still reasonable compared to the other asset classes, but it's something you have to be very aware of. If you have a unsophisticated investment manager that is not properly accounting for those capital expenditures, it could be pretty damning. Now, what's nice about, as you can see here, ground leases, you have practically no CapEx, and net leases, which you have only 3% on average, though there's a de minimis impact on the economic cap rate. So if you can buy net lease assets or ground lease assets where it's secured by higher yielding assets like office or hospitality, then you're kind of getting the best of both worlds. You're getting a higher cap rate with a lower hit of capital expenditure on your NOI. So really interesting stuff to look at there and be aware of as you look at different opportunities across different sectors. The other element of this to be aware of is uh, the impact of operating expenses on NOI. And there are a lot of operators out there that will say, my rent is going to grow 4% a year and my expenses are going to grow 2% a year, and therefore I'm going to have compounded NOI growth that exceeds that. In reality, there are certain elements of operating costs that are out of the control of the operator. And one that I want to highlight today is insurance premiums. And so you can see that really from 2018 to 2024, we have been in this really high, elevated increase of insurance premiums across the board, reaching a peak in 2023 of more than 20% in an annual increase in those insurance premiums. And that has a big impact on ultimately what your NOI looks like. And it's very hard, as you might imagine, to see this kind of hockey stick increase in insurance premiums in your original underwriting. And so one thing we always caution investors to account for, if you are responsible for insurance premiums, if you're not in a triple net lease deal, hey, make sure that you're accounting for some level of buffer there when it comes to those insurance premiums, because you're at the whim of the insurance companies, and they ultimately move the market entirely. If you look at what's going on in California right now, residential real estate has been impacted because there are insurance companies that have just walked away from insurance policies in California. They won't insure anything going forward, and that makes it a smaller, tighter market where premiums can get elevated even faster. Moving into our last section, this is about intelligent investing. And so this is really just some advice, frankly. This is what we do at Sentinel when we analyze deals, and that we want to convey for you folks if you're looking at other opportunities. And so within our net lease strategy, we have 6 key pillars that we underwrite. And we have about 40 different unique submetrics in these 6 pillars that we rank and score to come up with a risk profile for each deal we potentially acquire. And whether operators you work with, whether you're a GP, if you're not doing this, you're leaving yourself open to making a lot of mistakes going forward. And so on the right, I put what some other pillars could be for different strategies. But I implore you to be thoughtful when you're acquiring assets or investing in assets, to understand the key drivers of risk in each of those. A big element on value add I see right now is value add multifamily. Is I see a lot of operators that underestimate the renovation plan and the cost center around it. They overestimate the new rent they can charge, particularly if they're in a market that has rental demand softening or NOI growth that's slowing. And then they're very aggressive on their exit assumptions. And, if you're in a top 25 market where you have institutional presence there all the time, you have a little bit more flexibility on your exit assumptions, but because you have a more liquid market there than you do if you happen to buy a Class C property in Topeka, Kansas. The buyer pool there is a little limited. You're probably not going to trade it at a 4.5 cap. So really something to be aware of, and something that I think with as much transparency as you should be getting from operators today, that you should start to utilize.
Dennis, one of the things you point to is just the differentiation between operators now versus before. You could have been an operator, you could have raised capital and had very little capital of your own in a deal 5 years ago. A lot of originators, a lot of syndicators, younger folks, not a lot of capital of their own, based on market assumptions that everyone was using. The key today, though, is that those assumptions don't hold. So it's what assumptions do hold, and what are very insightful kind of risk-adjusted assumptions to apply now. And one of the things that I think any investor needs to consider is, regardless of the assumptions, what is the experience of the operators? How long have they been in the business they're involved in? Have they been through peaks and valleys? Have they seen distress before? Do they have the capacity to deal with problems? And do they have their own money invested alongside me in any meaningful way? I think that regardless of everything that's said, those are really important factors. On top of just not using, as Dennis, you're alluding to, old school playbook assumptions that just frankly really don't hold.
Right, right. One other real element, I have some great conversations with both passive investors as well as operators when it comes to this topic, which is IRR contribution, and where does your profit driver of your deal come from? And so the best way to explain this is the more of your deal's return comes from things that you can't control, the higher the risk is, right? And that's why in something like ground up development, where you have a ton of variables, you have a long time frame, you have exposure to capital markets that could change at a whim, the return profile needs to be higher because you're taking on substantial more risk than buying a core asset that's already stabilized with no lease up or no construction risk. And so then it comes down to, well, what percentage of that risk is being allocated to each of the component of the deal? Your profit comes from three things. It comes from the contractual income at the property. It comes from the NOI growth and the change in that in the terminal value of the property, assuming the same cap rate at acquisition and disposition. And then it comes from cap rate compression. And let me tell you, nobody has any control at all over cap rate compression. So that is a variable that sits on every deal. And if it happens, great. If it goes the other way, it can be a bit of a disaster. I didn't put cap rate expansion in here because cap rate expansion, as we saw from 2022 to 2024, can move quickly in the wrong direction and put even great deals underwater that had great solid fundamentals. So when you're looking across these different strategies, you'll see that, with core strategies, nearly 90% of the IRR comes from either contractual income or NOI growth, and most of that NOI growth is going to be contractual, at least when it comes to net lease deals. When it comes to value add, you're hoping that your operator is adding some level of value, a property improvement plan, capital expenditure plan that can then boost rents and ultimately create that NOI growth. Opportunistically, you're buying something at a heavy discount. Maybe it's distress. It probably has a very little contractual income in it at all. Almost everything comes from NOI growth. But you'll find that in the opportunistic bucket, they tend to be most aggressive on the cap rate compression because they are overvaluing the stable value of that property because they're buying it in what they think is total disrepair for a trophy asset. And if that doesn't occur, then it's going to have an impact on that IRR. So just really something to consider, and it's something that we stress test on every asset we acquire. It's something that we encourage every operator to show to their passive investors what it looks like, what the composition of the IRR, where it comes from, and what the IRR would look like if certain things change. If you're buying deals and you're expecting a 300 point basis swing on cap rate compression, you're not doing much to the property, that's a huge red flag. And then lastly, really just understanding our playbook, how we see the market right now, kind of pulling all of that information I just shared with you on what we're doing. So, Fred and I both have deep experience in other asset classes. I ran one of the larger build to rent platforms in the country. Fred is a multifamily and single family investor, as well as a very large private lender. And so we are constantly assessing these other sectors to see if there's opportunity there where we think we can get outsized return relative to the risk. And we're just not seeing that in these other sectors at this time. It doesn't mean it's not there. It just is there enough to scale? Is there enough to do it consistently? And that's why, we have shifted our strategy to reflect the current market environment where we think we can buy at these outsized cap rates. We're buying assets where the capital expenditures are lower, which result in a higher economic cap rate. And almost, I think, in every instance of every deal we've acquired, there is contractual rent increases on absolute net leases or triple net leases, which really allows us to predict with great confidence that NOI growth going forward. And ultimately, that gives us an adjusted unlevered IRR that is superior to everything else we're seeing in the market. And we're not taking any of the risk we see a lot of other strategies have to take. And so when it comes down to our core business itself, it's really about being active in the market, being disciplined, and focusing on what we think are mission critical properties in the right location so that we can deploy this capital with conviction. Fred, any last comments on kind of where you're seeing opportunities in the market, either with what we're doing in Sentinel or beyond?
Well, I think that one of the things we've all learned is that duration really matters, and the ability to get through a cycle really matters, because it's to consider risk adjusted returns today is more important than anything. And I think our core focus is to just as a lender or a debt provider thinks about taking underlying lower levels of risk over a longer period of time, we're thinking the same way at Sentinel. We're looking at how do we lock in imputed equity from the start for a long period of time at rent rates that are inside the market, that are fairly priced, and over a long period of time, so that as markets gyrate and there's turbulence in the market, we can sidestep that turbulence, and to the extent that we see capacity kind of correct. We obviously are in markets that are consolidating in all asset classes, and I think that there's opportunity in taking advantage of that consolidation by buying right in the right niches, whatever the asset class may be, and making sure you lock it down with new assumptions, conservative assumptions, with some level of duration and time, with cost of funds that are priced well enough to match up with that time. And given Dennis and my experience in the capital markets and in the banking world, that's a core focus for us. So we think in general summary, if I had to put a word on 2026, it's intense turbulence. We've seen some level of turbulence before, but I think the plane is shaking a little more today than it has been. But there's actually real opportunity, though, in that turbulence, and dissecting the markets, and then going long with the right assets.
Yeah, great point, especially about duration. Really, in this turbulent market, that extra longevity in your asset gives you total flexibility to clip a great coupon, sell opportunistically when the timing makes sense. And I think that's really a great way to end it right there. So thank you very much for everyone for listening. Fred, thanks for joining me. Laura, thanks for setting it up. If you would like a copy of this presentation, just go ahead and spam Laura on email, and she'll forward the presentation to you. If you'd like to learn more about investing with Sentinel, you can scan the QR code there, and you can download our funds investment summary. I think we have some year-end incentives for new investors. We've got 2 properties closing in the fund, properties number 7 and 8 in the fund, closing in the next few weeks. So timing is great. Thank you all again, and have a great rest of the week.
Thanks, everybody.
Thank you.